In October 1929, the stock market didn't just crash. It revealed something far more terrifying, that the entire American prosperity of the Roaring Twenties was built on borrowed money, false confidence, and a system that rewarded speculation over production. 95 years later, we're not just remembering history, we're repeating it. And this time, the stakes are exponentially higher. The parallels aren't coincidental, they're structural. When you strip away the modern technology, the cryptocurrency, the algorithmic trading, what remains is the same fundamental architecture that imploded in 1929. Unprecedented debt levels, wealth concentration at historic highs, asset bubbles inflated by cheap credit, and a collective delusion that this time is different. But here's what the textbooks won't tell you. The Great Depression wasn't caused by the stock market crash. The crash was merely the symptom. The disease was deeper, more systemic, and it's metastasizing in our economy right now. Let me show you how. Between 1922 and 1929, the U.S. stock market increased by over 400%. Sound familiar? Since 2009, we've seen similar exponential growth, fueled not by productivity gains, but by the Federal Reserve's money printing and zero interest rate policies. In the 20s, they called it the new era. Today, we call it unprecedented monetary policy. The vocabulary changed. The mechanism didn't. Back then, ordinary Americans discovered margin trading. You could buy $100 worth of stock with just $10 down. Banks eagerly provided the leverage. Why? Because they were gambling with depositors' money, and the house was making fortunes on commissions. Today, retail investors trade options on their phones with zero commissions, using leverage they barely understand, while institutions deploy algorithms that can amplify gains and losses by factors of 10 or 20. The concentration of wealth tells an even darker story. By 1929, the top 0.1% of Americans controlled a quarter of the nation's wealth. Today, that figure has been surpassed. The wealthiest 0.1% now control more wealth than the bottom 90% combined. This isn't just inequality. It's a structural flaw that guarantees instability. Here's why that matters. In the late 20s, American farmers were already in depression. Rural banks were failing by the hundreds. Manufacturing was declining. Unemployment was rising. But Wall Street kept soaring because speculation had decoupled from economic reality. The market became a casino where the house always won, and the players kept doubling down because the music hadn't stopped yet. Now ask yourself, what sector of our economy is in depression right now while markets hit record highs? Commercial real estate is collapsing. Small businesses are closing at alarming rates. Personal debt has reached levels that would have been considered catastrophic just a decade ago. Credit card delinquencies are accelerating. Auto loan defaults are climbing. But the S&P 500 keeps reaching new peaks. The mechanism of collapse is becoming visible. In 1929, when the market finally turned, margin calls created a death spiral. Investors who bought stocks with borrowed money were forced to sell to cover their loans. Each sale drove prices lower, triggering more margin calls, forcing more sales, in an accelerating cascade that obliterated 75% of market value in less than 3 years. Today, the leverage is more sophisticated but far more dangerous. Exchange-traded funds that promise double or triple returns. Algorithmic trading that can execute thousands of transactions per second. Derivatives markets measured in hundreds of trillions of dollars. Crypto lending platforms offering unsustainable yields. Each one amplifies both gains and losses, creating a system where the eventual unwind could make 1929 look controlled. I want you to comment below. Which parallel concerns you most? The debt levels, the wealth inequality, or the disconnect between markets and reality? Because understanding which dominoes will fall first might be the most important question of this decade. The response to the Great Depression offers both warning and instruction. Initially, the Hoover administration insisted the economy would self-correct. They cut government spending to maintain a balanced budget. They allowed banks to fail by the thousands. They stood by while unemployment reached 25% and industrial production collapsed by half. That orthodoxy deepened the disaster. When Roosevelt took office, he abandoned conventional wisdom. Bank holidays stopped the cascading failures. Deposit insurance restored confidence. Massive public works programs put millions back to work. Agricultural support stabilized food production. It wasn't perfect, and it wasn't fast, but it acknowledged a fundamental truth that today, as policymakers, seem determined to ignore. When private markets fail catastrophically, only government intervention on a commensurate scale can prevent complete collapse. But here's where history offers its darkest lesson. The New Deal arrested the Depression's freefall, but it didn't end it. What finally pulled America out was the Second World War, the most massive government spending program in human history. The mobilization of the entire economy toward a single purpose. The acceptance that solving the crisis required transformation, not restoration. We're not advocating for war. We're pointing out something more disturbing. Our economic system seems incapable of generating broadly shared prosperity without either unsustainable debt bubbles or catastrophic conflict. That's not a bug. That's the operating system. The ghost of 1929 isn't haunting us from the past. It's standing in our present. The same speculation over production. The same privatization of gains and socialization of losses. The same concentration of power that insulates elites from consequences while ordinary people bear the costs of their failures. The differences that exist make our situation more precarious, not less. In 1929, most Americans had minimal debt and owned their homes outright. Today, household debt exceeds $14 trillion. Then, social safety nets didn't exist, creating immediate and visible suffering that forced political response. Now, those safety nets create just enough cushion to delay the reckoning while problems compound. Global interdependence means contagion spreads faster and wider than any previous crisis. When Lehman Brothers failed in 2008, the shock waves circled the planet in hours. The next collapse will be measured in minutes. Our financial systems are more connected, more leveraged, more complex, and more fragile than at any point in human history. Central banks have already exhausted the tools that were supposed to prevent another depression. Interest rates were kept near zero for over a decade. Balance sheets expanded from billions to trillions. When the next crisis hits, what arrows remain in the quiver? Negative interest rates? Direct money printing? Universal basic income? These aren't solutions. They're admissions that the system is broken. The crucial question isn't whether another collapse will happen. History's pattern is clear. Periods of extreme speculation always end in crisis. Always. The question is whether we'll learn from 1929 or repeat its most devastating mistakes. The optimists will tell you we have safeguards now. Deposit insurance, circuit breakers, stress tests. The Federal Reserve's unlimited intervention capacity. But those safeguards weren't designed for a crisis of this magnitude. They're seatbelts in a car heading toward a cliff. Useful, perhaps, but not sufficient. The pessimists will tell you collapse is inevitable and imminent. That's equally false. Complex systems can remain unstable far longer than rational analysis suggests. Japan has been managing deflation for 3 decades. Europe has survived multiple existential crises. The ability to postpone reckoning is the modern financial superpower. But postponement isn't prevention. Each intervention that avoids immediate crisis makes the eventual reckoning more severe. Every bailout that protects failed institutions rewards the behavior that created the failure. Every round of quantitative easing that inflates asset prices increases inequality and instability. We're not solving problems. We're compounding them while pretending the medicine is working. The ghost of 1929 whispers a simple truth that power refuses to acknowledge. You cannot build sustainable prosperity on debt, speculation, and inequality. Eventually, gravity reasserts itself. The only variable is how much pain we accumulate before accepting that reality. History doesn't repeat, but it rhythms. The beat playing now is ominously familiar, and the musicians seem determined to play until the building collapses around them. If this changed how you see our current economy, subscribe. History doesn't give us answers, but it shows us the patterns. And this pattern is accelerating. Share this with someone who needs to understand what's coming, because the time for comfortable ignorance is running out.